We are here at the GAIM conference, and Adam, you have been a champion of additional monetary stimulus in England for quite some time now. Where do you come down on the whole stimulus versus austerity debate? Is it a mixture that's needed, or is austerity the wrong way to go to try to fix an economy?
Well, obviously, Michael, it depends very much country to country. And very simply, on the fiscal side, if you don't have enough money and your interest rates are going up, then you have to engage in austerity. If you have the credibility with markets, that pressure may be a little less, and that's a gamble governments have to take. But that's not really my department. For me, the monetary ease is the right way to go because, first off, we're seeing a slowing in all the G7 economies, not just the UK, and that means inflation's going to be low, and that's what I've been expecting for a while. And secondly, because it's going to help with the restructuring, and it's going to help pay off the debts. I don't mean inflating away the debts, I mean creating a more stable, growing environment which allows governments and people to pay their debts.
Well, obviously, the recession threat comes primarily at this point from Europe. How concerned are you about the euro crisis effect on the UK and the rest of the world, including the United States?
I mean, the euro crisis, or the potential for the euro situation becoming an overt crisis, is obviously first order big, particularly for the UK. We cannot disengage from Europe. We are part of Europe commercially, financially, trade, and this isn't just empty rhetoric. This is real ties to the economy. And whatever we at the Bank of England do, a lot of that's determined by Europe. But I also want to stress that this isn't like there's this sudden new shock. There were vulnerabilities in the US, in the UK, in Central Europe that have been there for a while, and a number of us have been speaking about. And the slowdown isn't so much this new development of news out of Europe, it's the weaknesses just rearing their heads as expected.
Well, how worried are you about the effect of this all on banks in Europe, in the UK, in the US?
I'd be a fool not to be quite worried. We'd like to think in the UK, and my colleagues on the financial stability side at the Bank of England have worked very hard to make sure we know where the exposures are as best we can. I mean, I think that's the big lesson from 2008 is you want to try to know where the exposures are and you want to try to force banks to provision for them. But if we saw major sovereign losses on sovereign paper and then losses on European banks, Euro area banks, then that would be a material impact on the capital position of UK banks. And so we have to face that reality and be prepared to deal with it. We are doing everything we can to pre-provision, to know where the weaknesses are. But in the end, if there is a major recapitalization of the European banking system, the UK has to be prepared to deal with that.
Well, do the bankers realize? Do the bankers know where they are in this?
Well, our supervisors have certainly been telling them. Our policymakers, myself included, have certainly been telling them. Your reporting has certainly been telling them. If they don't know, then they should be out of business.
The Bank of England issued a very negative statement last week when it announced more QE. Will £75 billion of asset purchases be enough this time?
We are going to review it on an ongoing basis. I mean, formally every month. It's not the Bank of England, it's the MPC, the Monetary Policy Committee. We review it on an ongoing basis and every month, and we will readjust it. If it turns out we need more, and my colleague Martin Wheel gave an interview recently in which he was talking about potentially the need to do more, we will do it. I think the important thing to recognize is we view this as just more monetary policy in response to an outlook that says inflation's going to be below target and there's downside risks. And so we will do what it takes to make it happen. I do think $75 billion over 4 months is enough to make a material improvement in prospects versus what it otherwise would be, and is the right place for us to start now.
Do you think if you do another round, it goes beyond gilts, beyond just government bonds?
The governor of the Bank of England has been pretty clear that he doesn't want the bank to go there. And frankly, or not frankly, legally, that decision is by the executive of the bank, not by the MPC. What I think has been fruitful is Chancellor Osborne, Business Secretary Cable, and others have picked up on the call I made last month that you have to think more broadly about improving the transmission of credit in the UK, which is this long-term structural issue as well as a short-term stimulus issue. And the Bank of England stands ready as agent, as provider of liquidity with the facilities we already have to support that if the government does pursue those kinds of measures. But that's not the same as us directly buying assets. I would point out the real issue is the lack of lending, the lack of securitization of lending, the lack of corporate bonds in the UK. I mean, we could buy up all the corporate bonds in the UK and it would be relatively small if you leave out the financial system in GDP terms. And so that's one of the main reasons why we're sticking with gilts.
Adam Posen, thank you very much for making time for us today here at the GAIM conference.